Earlier today, I was pulled into a conversation, and um, it was a real simple question, and I kind of chose violence. No, I didn't choose violence. I didn't assault nobody. I didn't verbally harass anybody. But I was asked a question. Well, a question was proposed, and then someone asked me what I thought about it. So, shout out to Russ and Emma on the public app. Russ actually posted a very thoughtful and insightful thread about inflation hedges, and that really it was just so well put together and so thoughtfully executed that when I was asked the question, asked to answer the question that he proposed inside of that post, I decided to approach the issue from a different angle than most people would. And instead, like I said, just like tonight's stream, I decided not to go with facts and figures and all of that. I didn't even cite anything in the post, which is really weird for me. But I didn't cite anybody because I was kind of scared that I might misquote or get somebody wrong. And the last thing I want to do is slander the name or the legacy or the work of these award-winning and world-renowned economists and journalists who I've taken a lot away from. And I think it would be a great disservice for me to parrot what they said. So I took my own interpretation of their words, and I've been thinking about it, and it really formed my opinion of the whole issue of hedges against inflation. Now, if you know me, you know I'm against gold. Every time I see an advertisement telling people the economy is crashing or our money isn't worth anything, buy gold, it angers me. It makes me mad, and this is why I said I chose violence, because this gentleman Russ, he asked a question, and generally when people issue this question, the inflation hedges that people suggest are precious metals or Bitcoin or other things like that. And the reason why they say these things are because we all know the gold price goes up and down. And what we are witnessing when that happens, we're not witnessing the price of gold going up and down. Gold is a material, it's a commodity. There are shortages, there are demands, it's a supply and demand thing. But most of the time, when you look at the price of gold, you are actually looking at the price of your dollar increasing or decreasing. You actually are able to, for most times, look at your dollar gain or lose buying power by the price of gold. And that's the way I view gold. I look at finances a little bit different from most people, but the whole thing about gold is everybody say gold doesn't lose value, and they're right, it doesn't lose value, but technically it doesn't gain value either. You're watching your dollar fluctuate the same way your $1 used to buy 4 bags of chips for 25 cents, and now they are charging 75 cents for that same 1 bag of chips. That's what inflation does. Inflation decreases the buying power of your dollar, and reflation is when your buying power gets a little bit bigger and your dollar buys more, your one single US dollar. And the US dollar fluctuates and changes, so does other currencies. But what he was getting at is, if your dollar is losing value and you are saving money, that $1 million that you saved up or that you managed to save from your income, when you go to retire, it's not going to buy you $1 million worth of goods, what you thought $1 million worth of goods were today, in 20 years. Because we all know that the dollar, or just in general, our target for inflation is negative 2 to 3 cents per year. So you lose about 2 to 3 cents of every dollar per year. And after a while, you're losing a lot of power from your dollar. So people say to escape this, if you buy gold, you'll be safe. They say if you buy Bitcoin, you'll be safe, because they are not tied to the dollar. And that's somewhat true, but that's my pet peeve because gold, it's terrible. Have you ever felt how heavy gold is? Gold is the only material, and I'm parroting right now, is what somebody else said, and so many people said that I don't even have an adequate quote for it, but basically gold is the only thing that you pay somebody to dig out of the ground, you polish it up, and then you pay somebody to lock it away. And then when you go and you decide to get rid of this gold, you have to go to a gold broker because you can't just take a gold bar to Subway or 7-Eleven and get yourself a Slurpee or whatever. So gold isn't a currency, and that's the problem that I have with gold. It's not a currency. Same thing with Bitcoin. Bitcoin is digital gold, but it's technically not a currency. It's called cryptocurrency, but in a lot of places you can't go and use Bitcoin, and that's changing because PayPal has it, hooked up into their card, and you got Venmo and Square, and everybody is incorporating Bitcoin into their platform. But technically, Bitcoin isn't a currency right now, and it may be, and that may be the future. But looking at Bitcoin, I wouldn't want to store my money in there if it's going to take another 50% dive. And the same thing with gold. Gold prices are actually kind of down. And the reason why the gold price is kind of down is because the strength of our dollar is slightly up. The economy's open. Everything is going well for the economy. So everybody who invested in gold before COVID, they may have made some money, but if they didn't cash out, then they're losing steam, losing cents and dollars on their investment that they thought was a hedge against inflation, because inflation went the other way and gold went that way, rather than the dollar losing value and gold going up. So that's my problem with gold and Bitcoin. So when I was proposed this question, I figured I would go off script. I would bring in an argument from an economist standpoint, and I'm going to read it, and I might expose my little bit of dyslexia or whatever, but so basically, the question was, love to hear your thoughts on this. How do you think the rates of printing will affect inflation, and what hedges do you have in your portfolio? What hedges? How do you hedge your investments or your savings against inflation? And so I started off my answer with, historically speaking, America's strategy for dealing with inflation and debt seems to be, hey guys, let's see if we can outgrow this inflation. Let's see if we can outgrow this debt. And I want to talk on these points a little bit later. So let's see if we can outgrow this debt. Historically speaking, that's how we handle it. I've played that game with my credit card balances and my income, and it never ends well for me. Somehow I managed to get a credit increase. I managed to get my yearly raise, which doesn't always come yearly. But even when I keep up with that pattern of outgrowing my debt and getting more credit and getting more income, so I have less debt to income, not because I paid off my debt, but less debt to income because I've actually gained more income, which makes me a lot more attractive to banks. And also by increasing my credit limit, so yeah, I still owe the same amount, but now I have more available credit. And that's one way you can do it, but you can't do the same thing that the government does with their wallet, because you can't print money. But I went on to say that's an unwinnable game. Government debt and GDP work slightly different because obviously the government and senators are the only people on earth who can vote themselves richer through monetary policy or congressional pay raises. When the money isn't real, inflation is the only threat, and contrary to popular opinion, raising taxes won't help. Taxes are not government income. If they were, we couldn't blow our budget every year. Taxes only exist as a weak monetary tool. It takes money out of the economy, not the global money supply. It decreases the local money supply, but not the global supply. You got Google who operates worldwide, all these companies who operate worldwide, and we tax them on the money that they earn in the US. We don't tax them on their global earnings. So that's not a tool that the Federal Reserve or the IRS can, which both are under the U.S. Treasury Department. That's not a tool that they can use to actually bring money back to America, bring money back to the government. That's not how taxes work. So it's a weak monetary tool that takes money out of the local economy, the local money supply. My hedge is living within my means because although the Fed controls the money supply, banks control money creation through credit, mortgages, loans, and debt. If you live within your means, who cares what money is worth? You can always borrow more or use leverage to acquire new non-depreciating assets like real estate. And the best thing about real estate is a 10% deposit will get you a 1,000% return in the form of a house. Now, that's slightly off. That's hyperbole. I was being sarcastic. But yeah, you can put down 10 or 20% and get control of an asset that is worth hundreds of thousands of dollars. That's leverage. That's like sitting on a seesaw, putting a $10 weight on a seesaw and lifting 100 pounds. Where else can you do that in our economy? Where else can you do that? You can't even do that in the stock market with stocks, just by putting down this and automatically somebody gives you an asset to control that's worth this much money. So I said that that's how I prevent inflation. It's basically gathering assets. The only solution is to have liquid assets like cash and cash equivalents. And cash equivalents, I went over that last week, were like treasury, stocks, raw materials if you're a company, if you have a whole bunker full of crude or whatever, those are raw materials, industrial materials that have value on the international market. You can make things out of them. People trade them daily on the commodities markets. So the only solution you have is liquid assets like cash and cash equivalents, which includes treasuries, and have good credit. I run my finances like a business, and government, or government. The only thing better than having cash is having the full faith of credit institution, cash and assets. So basically, in my answer, which was a long answer, and I kind of summarized some of it right there. But basically, within my answer, I use macroeconomist Stephanie Kelton's debunking the inflation myth as fodder for my argument, and I probably poorly explained her theory as a macroeconomist, and I don't have any degree. So, and I also touched on Lawrence Michel's cases of wage strength. I'm sorry, I'm misquoting the name of the article, but that article was really well written. And basically, when it comes to inflation, you can try to out-earn inflation, but once you convert your hours to dollars, because you get paid per dollar, that money, there's no way to really secure that money from not being inflated. You can put it in the stock market, and you can hope to beat inflation with your stock market's returns, which are generally thought to be around 10% per year. So you're beating it by, let's say, 8%. You're beating that 3% mark by almost 8% if it's a good year, but we have bad years in the stock market. You can put it in the bank account and you can earn interest, but unless you're earning more than 3% interest, then you're not beating inflation. So once you turn your money into cash, everybody tries to beat inflation. And my theory was just simple. Don't beat inflation. Live within your means. You want to save, you want to invest, but you can't worry about the price of money, because the price of money is always going to change. And in order to buy or sell anything, you have to use money, unless you use credit. And that's my key to beating inflation is credit. It is not using my credit card, but keeping credit available. So, because as a hack, if I don't have a balance on my credit cards, I can always use the bank's money, and the money that I use from my credit card from the bank isn't affected by inflation because I'm spending today's money. Now I got to pay for it later, but if I have savings, I can pay that off in today's dollar. So my hack, and if you're an economist, if you're a mathematician, if you're an investment professor, rescue me if I'm wrong, help me out, and and I'm not being sarcastic. Somebody crunched the numbers on this, but my theory is, and this is my personal belief, unproven theory though. If I make sure my debts are paid, I'm not running a balance, I'm not getting charged interest on my credit card and past debts. And if I have money, but it's tucked away in the stock market, tucked away in treasuries and all of that, I can use the credit card's money today, and I don't need to keep billions or hundreds or millions of dollars worth of savings. And with my current money that I earn, I can secure assets that don't lose value, like land or property, which generally goes up, or it really declines in value very slowly. You buy a house, you might have to put a 20-year roof on it, but like over that 20 years, if you bought a car, the car is useless. So my theory is to buy assets, take your money and do something with it. Invest it, buy assets, do something where it's not going to lose its value,